It's a Sunday afternoon. You're sitting at the kitchen table with a cup of tea, opening your year-end statement from your 401k. You've worked hard your whole life. You're 58 years old, still working, still saving, doing everything right. Then your phone buzzes. It's a message from your HR department. The subject line reads, "Important changes to your 401k catch-up contributions for 2027. You open it, and as you read, your stomach starts to sink. It says that because of your salary, you will no longer be allowed to make your catch-up contribution the way you've been doing it for years. No more tax deduction, no more lowering your taxable income. Starting January 1st, 2027, every extra dollar you put into your retirement plan will be taxed up front before it even reaches your account. You read it again, you think there must be a mistake. You've been counting on that tax break to help you retire on time. You feel a knot in your stomach. You wonder, is this real? Did Congress really do this? And what can I do about it before time runs out? If you are 50 or older, still working and earning a good income, what I'm about to share with you could be the most important 12 minutes you spend this year. Because there is a window in the tax code that closes permanently on December 31st, 2026. And once it closes, it does not open again. My name is June. I'm a senior policy analyst, and for years I've helped working Americans and retirees understand the fine print buried inside our tax laws. Today, I'm going to walk you through exactly what's changing, who it affects, and the 3 steps you must take before the end of 2026. But please, stay with me until the very end, because there's a mistake that even smart, well-prepared workers are making right now. A mistake that could cost you thousands of dollars in lost tax savings, or in the worst cases, cost you your catch-up contribution entirely. This is Retirement Tax and Law Pro. Let's get into it. Let me tell you about Margaret. Margaret is 61 years old. She lives in Charlotte, North Carolina. She's a senior project manager at a regional engineering firm. She's been at the same company for 22 years. She earns about $165,000 a year. She has a comfortable home, 2 grown children, and a 4-year-old grandson she adores. Margaret has always been disciplined about her 401k. She contributes the maximum every single year. She especially loves the catch-up contribution, that extra amount workers over 50 are allowed to put in. Because Margaret is between 60 and 63, she qualifies for the enhanced super catch-up of $11,250 in 2026. Combined with the regular contribution limit, she can stash away over $35,000 in a single year, all of it lowering her taxable income. Margaret plans to retire at 65. She's been counting on 3 more years of these big pre-tax contributions to bring her over the finish line. Then, one morning in early 2026, Margaret's benefits coordinator sends out a memo. The memo explains that starting January 1st, 2027, because Margaret earned more than $150,000 last year, her catch-up contribution can no longer be made pre-tax. It must be made on a Roth basis. After tax, no deduction. Margaret runs the numbers. At her tax bracket, that lost deduction means she'll pay roughly $2,700 more in federal taxes every single year, just on the catch-up portion. Over 3 years, that's more than $8,000 out of her pocket. But here's what hurt the most. Margaret realized that 2026 was her last chance. Her last full calendar year to make that catch-up contribution the old way. And if her plan didn't add a Roth option in time, she might lose the catch-up entirely. Margaret did not panic. She got informed. She acted. And I'm going to show you exactly how, so you can do the same. Let me explain the rule in plain English. Back in 2022, Congress passed a law called the Secure 2.0 Act. Inside that law, there's a provision called Section 603. This section changed how catch-up contributions work for high earners. Here's what it says. If you are 50 or older and you earned more than $145,000 in the prior year from the employer who sponsors your 401k plan, your catch-up contribution can no longer be made on a pre-tax basis. It must be made as a Roth contribution. That means after-tax money, no upfront deduction. The threshold is adjusted for inflation each year, and for catch-up contributions made in 2026, the trigger is prior year wages of $150,000 or more. Now, in September 2025, the Treasury Department and the IRS published the final regulations. They confirmed that this rule applies to taxable years beginning after December 31st, 2026. That single sentence is the most important sentence in the entire tax code for high-earning workers over 50. What does it mean in real terms? It means 2026 is your last calendar year to make a catch-up contribution the traditional pre-tax way if you fall into the high earner category. Starting January 1st, 2027, the door closes and it does not reopen. Let me be very clear about the numbers for 2026. The standard 401k contribution limit is $24,500. If you're age 50 or over, you can add another $8,000 catch-up on top of that. And if you're between the ages of 60 and 63, you get an enhanced super catch-up of $11,250. So your total possible contribution for 2026 ranges from $32,500 up to $35,750, depending on your age. For all of 2026, every dollar of that can still be pre-tax for everyone, as long as your plan still allows it. But starting in 2027, if you made over $150,000 in 2026, that catch-up portion of $8,000 or $11,250 has to be Roth, period. And here is where it gets even more serious. The final IRS regulations say that if your 401k plan does not offer a Roth option at all and you're a high earner, you lose the catch-up contribution entirely. Not delayed, not deferred, forfeited. This is why this matters so much, and why the end of 2026 is a real, hard, permanent deadline written into federal law. Now let me warn you about the most common mistakes I'm seeing right now. The first mistake is assuming this doesn't apply to you because you're already partly retired. If you still earn W-2 wages from any employer that sponsors a 401k you participate in, this rule may apply. Part-time work counts. Consulting work that's paid as W-2 wages counts. The second mistake is confusing the $150,000 threshold with household income. This is individual wages from the plan sponsor, not joint income, not investment income, not Social Security. If you and your spouse together earn $250,000, but each of you individually earns under $150,000, neither of you is affected. The third mistake is assuming self-employment or 1099 income counts. It does not. The rule applies only to FICA wages, which are W-2 wages subject to Social Security tax. If you're a sole proprietor with a solo 401k or a partner in a partnership receiving earned income rather than W-2 wages, you keep your pre-tax catch-up rights indefinitely. The fourth mistake, and this is a big one, is assuming your employer will automatically handle everything. Some plans will, some plans won't. If your plan does not offer a Roth option by January 2027, you could lose your catch-up contribution entirely. You must verify what your plan offers now, in writing. The fifth mistake is confusing this with a Roth conversion. A Roth conversion is when you move existing pre-tax money into a Roth account. This new rule has nothing to do with that. This is only about new catch-up contributions going forward. So let me give you the 3 exact steps you need to take before December 31st, 2026. Step 1. Find out where you stand on the income threshold. Pull out your most recent W-2 or your year-end pay stub. Look at your FICA wages from your plan sponsor. If that number is over $150,000, you are a high earner under this rule. If it's under, you have more flexibility, but the rules can still change in future years as the threshold adjusts for inflation. Either way, know your number. Step 2. Contact your plan administrator in writing. Ask 3 specific questions. 1. Does my 401k plan currently offer a Roth contribution feature? 2. Will my plan be amended to allow Roth catch-up contributions before January 1st, 2027? 3. If I exceed the wage threshold, will my catch-up contributions be automatically treated as Roth, or will I need to make a new election? Under federal ERISA law, you have the right to request and receive a summary plan description. Use that right. Get the answers in writing. Step 3. Maximize your 2026 pre-tax catch-up while you still can. If you are 50 or older and you have the cash flow to do it, make sure you contribute the full catch-up amount in 2026. That's an extra $8,000 if you're between 50 and 59 or 64 and older. It's $11,250 if you're between 60 and 63. This is your last chance to get the immediate tax deduction if you're a high earner. After December 31st, 2026, that deduction is gone forever for you. And here's one more piece of advice. Talk to a tax professional or a fee-only financial advisor before the end of 2026. The decisions you make in this final pre-tax window can affect your tax bill for the next several years. A short consultation now can save you thousands of dollars later. Before I let you go, I need to say something important. The IRS is not going to send you a personal letter reminding you about this deadline. Your employer might send a notice, or they might not. The news media will talk about it for a day and then move on to the next story. And YouTube notifications, as helpful as they can be, are not a substitute for staying engaged with your own retirement plan. The only way to truly protect yourself is to check IRS.gov directly, to read the materials your plan administrator sends you, and to keep careful records of your contribution elections. If you ever feel uncertain, call your benefits department, talk to a qualified tax professional, or visit aarp.org for free resources designed for workers and retirees just like you. December 31st, 2026 is not just another date on the calendar. For millions of working Americans over 50, it's the last day of a tax benefit they've used for years. Once it closes, it stays closed. There is no extension. There is no grandfather clause. There is no second chance. If you take just one thing from this video, let it be this. Find out your wage number, talk to your plan administrator, and if you qualify for that pre-tax catch-up in 2026, use it to the fullest before the window slams shut. You worked hard for every dollar in your retirement account. You deserve to keep as much of it as the law allows. I'm June, and this has been Retirement Tax and Law Pro. If this video helped you, please share it with a friend, a family member, or anyone you know who's still working and saving for retirement. The person you share it with may be the one who needed to hear this most. Stay informed, stay protected, and take care of yourself.